Hey guys, Matt McGlay here. Today we're going to be talking about the Fibonacci sequence, understanding its prevalence within the universe, and more importantly, its applications within the stock market. One of the tools we'll be focusing on in this video is the Fibonacci retracement, a tool which will better help you understand areas of support and resistance and potential opportunities to either enter or exit the market for profits. All right. So what is the Fibonacci sequence, and more better, why should I care about it? Well, some could even argue that the Fibonacci sequence is the pattern that built the universe. But before we get too deep and philosophical, let's just kind of talk about it and give a quick introduction. So it's a simple pattern of numbers that you can view on the screen right now. You can see it's 1, 1, 2, 3, 5, 8, 13, 21, 34, 55. It goes on forever, right? But the entire thing is just you take the previous number and add it to the current number, and it creates the next one. So 1 plus 1 equals 2, 1 plus 2 equals 3, right? So it's a pretty cool pattern, and there's so many different derivatives and angles that you can look at it that have some pretty unique tricks to it. For example, like if you take the sum of the numbers below, or the square root of 2 is 4, the square root of 3 is 9, right? And you start adding these together, let's say, so 1 plus 4 is equal to 6. Right? So what do we see here? 6 is also equal to 2 times 3. Then you take the next number, which is the 1149 equals 15. 15 is 3 times 5. So it's a complex series of numbers that have so many different patterns that almost reinforce it. So when you think of it in terms of laws of physics and the universe and chemistry, it's a very stable pattern, a very stable structure that has multiple supports throughout it. So it only makes sense that, this is kind of a pattern that's been used to build the universe, right? So we see it throughout everywhere. We'll see it through pineapples, with the waves of the ocean, see it in coral, in all forms of life, and even the basic human DNA follows the Fibonacci sequence. The human body follows a golden ratio, which is correlated to the Fibonacci sequence. Galaxies are made out of it. Everything like that, right? And if you even look here, we'll see, Donald Trump's haircut, his entire forehead and everything. It follows the Fibonacci sequence. So it's only reasonable to expect that human nature and behavior in some manner of a form also follows the stock market, or follows the Fibonacci sequence. So when you look at that, what is the stock market? What are these charts? What are the equity markets? What are these charts that we're looking at? It's a graph and a plot of human behavior. What do you mean it's a chart of human behavior? Well, look at here. These price fluctuations at the end of the day are being decided by millions of individuals deciding whether to buy or sell. And there's a theory called Wyckoff theory where he discusses the composite man. We'll go in another video more in depth into that later. But the concept is that we have supply and demand, which is ultimately dictated by greed and fear. People are buying and buying and buying. They believe that this is worth a lot more than it currently is, so they keep buying more and more. Once it reaches a certain price, people are like, whoa, no, this is way overbought. This price is not appropriate. So we start selling and selling and selling and selling, and the market starts going down and down. These fluctuations are merely the composite construction of millions of people's projected value of an asset. And in this case, the asset is the euro US dollar, a foreign exchange currency. But it could also be other forms of equities. It could be a car. It could be houses. Our mind is deciding what we believe is an appropriate price as a group on an object. All right. So if galaxies follow the Fib sequence, DNA follows the Fib sequence, why doesn't the stock market follow it? Well, it kind of does. That's what people have noticed, and that's the foundation behind using the Fibonacci sequences within the stock market. One of the very common tools that people use is called the Fib retracement. You're going to notice there's a bunch of other Fib things like Fib time zone, Fib spiral, all these. They all underlining follow the exact same principle. They're just different takes on using Fibonacci numbers in them, and we can experiment with them on a different video. But our focus on this video is going to be Fib retracement. This is a great tool that helps you analyze potential pullbacks on runs and find areas to maybe re-enter into a position or exit out of a position. So let's demonstrate. Here we have a rally of the Euro USD starting back in 2020 and going up until the 3rd of March 2020. So what we're going to notice here is we're trying to decide what are the potential areas that the market will pull back. If it pulls back past this point, should I be concerned, or is this just a natural behavior of the market? And when it comes to natural behavior, we go to nature. Once again, the Fibonacci sequence that's found in nature. So I go to the tab, I select my tool, Fib Retracement, and what I do is I start at the very bottom, the lowest point, and I take it to the highest point in the market. So right about there. Boom. I like to go to the candlesticks. It really depends on the trader. Some traders start at the bars, some go to whatever. It just, all that matters is that you stay consistent. So what we're going to notice here is that the Fib Retracement tool automatically drew a bunch of lines. These are Fibonacci sequences, all except for this 50 number mark. This is a number that the market tends to respond to very actively, so we draw it within the Fib Retracement. So here we're seeing, what does this mean? These are potential areas where the market will pull back to and you will find a support or resistance. It's not guaranteed, but it's a good probability. So we're looking here and we're saying, okay, the market might pull back to 23.6. This is a good point to maybe re-enter into the position or add on to the position, and then if the market starts going below to the 50 to the 61, maybe, okay, this is time to get out, or this is time to go short once it starts going in these regions. Kind of analyzing where are going to be my entries and exits depending what you're doing. So what we're going to do here is we're going to press play and see how it goes. So we see the market goes down and then boom, bounces right off of this level. You can see this is a support resistance level, but it's also a Fibonacci level. Keeps drawing and we're going to analyze what happens. Market goes up, and it blows past the points once it bounces past this Fibonacci level. So now that we have a new high, we're going to start from a low and we'll drag this all the way back up to the new high now. We have a powerful high and we're going to see how the market responds. Once again, keeping in mind these levels. Press play. We see bounces off that 23.6. That's twice in a row. Looks like a pattern's forming here. Maybe you're going, oh, I can use this. But let's see what happens. Oh, it breaks the 23. Now it keeps going down, and look at that. Bounces dang near perfect right off the 61.8%. So at this point, this is kind of the danger zone. Now we're thinking, okay, the 61.8 is a very strong support. If it does a 61.8 retracement, we're concerned that it might be going lower, especially if it breaks this. So now we're watching for the retest of the previous Fibonacci levels, the 38.2. Market tests it, fails it, goes back down to the 61.8. Tries to test again, doesn't make it. Keeps going, and ultimately it fails a test, and then look what happens. Fluctuated within these regions. Keep in mind, this is a period from March 12th to March 17th, so this is a 3-day period of the market trying to make decisions on what direction to go, and then ultimately it fails, and then it goes down. And look, boom, it starts hitting these other levels again. So this is a very useful tool that you can use to help you decide when to enter and when to exit, and potential areas where there's going to be indecisiveness or when the market might make a drastic change from an uptrend to a downtrend. I recommend you experiment with this, draw with a couple of lines, draw a couple of other areas and see how it goes. In a bear market, it'd be the complete opposite. So we'll delete this. I start at the top and I draw to the bottom. And you see how it responds. So boom, keeps going, and then the market starts bouncing. Look at that, goes up, almost hits this perfectly. Starts hanging out around these areas, and it's bouncing between this little area. You can see how it's finding resistance now at these areas, and it's interacting with these Fibonacci levels. Goes up, powers through there, and then look how the market is behaving with these Fibonacci levels. Once again, this is just a random chart that I chose. I didn't pre-plan this, but it does follow these patterns. Sometimes it won't. Sometimes it's going to be completely chaos, and that's the nature of the market. But with these tools, it can help you understand support, resistance, entry and exit positions, and how to better manage your risk. Hey guys, hope you had fun and enjoyed the video. If you found it of value, help me out and hit that like and subscribe button. If you want to follow me on my other social media sites, check me out on Twitter and Instagram at Matt McGlay. Link in the description.